Equity Mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity Mate.
Welcome to another episode of Equity Mates, a podcast where we help you learn to invest in 20 minutes or less. We break down the world of investing from beginning to dividend so that you can hopefully make some returns. My name's Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going, bro?
Yeah, very good, Bryce. How are you?
Mate, I'm well. You had the tennis on the weekend. How exciting.
Yeah, well, by the time we've released this, we'll know who won between Rafa and Novak.
Yeah, big game.
Yeah.
Last night's game was good as well, I think, the women's final.
Yeah, I didn't see much of it, to be honest, but I was at the semi-final on Friday where Novak just absolutely pumped his French opponent.
Yeah, that was disappointing, I guess, from your point of view to go and see that live. But well, it was disappointing from everyone's point of view. I guess we were expecting or hoping for a bit of a better contest, but I think Nadal did the same thing to his opponent in his semi. So tonight should be hopefully a ripper game.
Yeah, it should be. Now, look, some of the criticism we get is that our sport chat at the front doesn't age well for people who are listening later. So let's keep it to that.
All right, Ren. So this episode, we are going to do our Ask Us Anything, which we haven't done for December either because we're on our Christmas break. So what we have done is compiled all the questions that we've received over December and January from our listeners. We have a forum on our website for any new investors who have just joined us where you can go and ask us literally any question you want, preferably investing related, but we will try and answer any question that you throw our way. Ask us anything, and then each month, the last episode of the month, we go through and answer all the questions that have come through from our listeners. So that is what we are going to do today. However, there have been so many that have come through and some absolute crackers that we're going to be splitting this into 2 episodes to ensure that we can try and stick to our 20 minutes and not let it drag on. So without further ado, Ren, unless you have anything to add, let's get stuck in.
No, let's get stuck in.
All right. So we're not going to read word for word because some of the questions are quite large. If you want to see them, jump onto our website. They're all there. So this has come through from Nick, and it relates to the ATO and investing and tax time. And what are the sort of particulars when it comes to your investments and reporting at tax time, and what are some of the main things that we need to be aware of, Ren?
Yeah, so in a nutshell, there's probably 2 things, the 2 main things that you need to keep in mind, and that is the shares that you've actually bought and sold, they are considered capital and capital gains or losses, but then separately, the income that you receive from shares in dividends or, from bonds in coupon payments, they are considered income. And so they're treated differently. For income, so for the dividends, that gets pooled with all your other taxable income, whether it's from, rent, whether it's from your job, and that creates your total taxable income, and then that gets taxed as income. For capital, there's a slightly different way that it is treated. Capital losses that you make can be offset against capital gains and stuff like that. So that means if you lose money on certain shares, you can offset that against gains in future years. But look, I think the most important thing to keep in mind is that we aren't financial professionals and we can't and don't give financial advice. And the best person to speak to about this is, a tax expert.
Absolutely. Also, we did a much more comprehensive discussion on tax, episode number 62, called All Things Tax Time. So if you want to have a listen to a bit more detail, head over and check that episode out. We delve a bit deeper into some of that sort of stuff.
Yeah, and I think probably one thing that a lot of people don't do that they need to do is where they do make a loss in that year, make sure you report it, even if you don't have any gains to offset against it that year, because the only way you get to offset it in future years is if you report it at the time. So even though you might not want the ATO to see your terrible trade, make sure you record it for tax purposes.
And Ren, if I don't do anything during the year, say this year I buy A2 milk, for example, and then the next financial year I don't buy or sell, is there any reporting that needs to be done, or do I just let it fly through to the keeper for that year?
I don't believe so. I think you only need to report if there's been like a taxable event, and I think if you just hold it throughout the year, unless they pay you dividends, then you need to report that. But yeah, if you don't get paid dividends, if nothing happens and you don't sell, then no.
Nice.
But as I said, tax professionals give tax advice. We
don't
elaborate on a podcast.
All right, so thank you, Nick, for that question. Our next one comes from Alex, and this is a great one because Alex has just started listening to the podcast. He's pumping through a lot of episodes, and right back at the start, Ren, we were discussing A2 milk, and in February 2007, since we discussed it, it grew 400 to 500%, which was massive growth. And what he would like to know is the reason for us discussing the trading price to earnings, I guess, and why we gave it the valuation we did at the time, and also what were our learnings from seeing the stock trade, from where it was to where it ended up finishing, at the end of last year.
So to be clear, I think you're trying to be polite to me. But what he's actually saying is in, I think, our third episode or something, I said that A2 Milk was trading at 52 times earnings, and so I wouldn't be buying it. But since that time, it's grown about 460%. I had a look. In February 2017, it was trading in mid $2 range, and now it's $11.66. So, look, it is a good question, and it's a fair enough call out. And look, I was wrong, but in saying that, I still look at it today, and the same logic I think still can be applied. So at that point, it was trading at 52 times earnings. These days, it's trading at almost 65 times earnings. So its earnings per share are about 18 cents for a share price of $11.66. And whilst that isn't always a good indicator, and a lot of growth stocks have high PEs and continue to grow, A2 being an example, a lot of the tech companies in America being other good examples. You do just need to keep in mind what you're looking at when you see a price to earnings ratio, because really it is around the growth expectations of a stock and the growth that the market has priced into a stock. So if you just think about what it is telling you, it is saying that, well, if we take A2 back in February 2017, the market was telling us that if things didn't go right for A2's growth, and instead the company just stayed the size that it was, its China strategy failed, competitors came up, and it just continued to operate as a business the current size that it was, it would have taken 52 years for the business to spit out enough profit to make back your investment, just to make it back for you. And that is assuming that it paid out all of its earnings to its investors. Now, businesses don't do that. They retain a lot of their earnings to continue growing. So you as an investor, just to earn your investment back, would have had to wait, over 50 years. So when you see and price to earnings like that, the market is expecting serious growth, and in this case, it has grown, although the price to earnings multiple has expanded along the way as well. But it is just more risky to be investing in these high PE stocks, because if things don't go as the market expects and as the company is projecting, which in a lot of cases things don't go to plan, you have bought a very expensive stock. So that, I guess, that is what I was saying at the time. I'm still thinking it now, but hey, I was wrong once before, and I'm probably going to be wrong again.
Yeah, I guess you're just not comfortable saying, buying in now, but what did you do with your stock over this period of time? Have you kept A2 Milk? You obviously bought into the stock very early, well before the $2 mark. And so you'd already experienced pretty phenomenal growth when it hit $2, which triggered this conversation at the 52 times earnings mark that we were talking about. So have you still got the stock? What's your plan with it? Do you have an exit strategy? What are you doing? You obviously still think that it's now 65 times earnings, so your approach, I guess, to the stock hasn't changed, but what are you doing?
So I think I've said this to you before, maybe not on the podcast, but my sell indicator for A2 milk and for Bellamy's is when we stop hearing about people fighting about it in supermarkets. I think
interesting.
Yeah,
that's fair enough. Though.
It's probably not that scientific, but I think it is indicative of demand that we're seeing. So every time you hear a news story or you see a current affair reporting on Chinese Daigous buying up all of the infant formula from supermarket shelves to sell it for 10 times the price back in China, when you hear about these companies not being able to keep up with demand, for me, that's probably as good an indication that there's still growth left in it, which I know contradicts what I said earlier, but obviously there is risk there because all you need is for a Chinese competitor to start up in China, or for there's heaps of things that could happen, or for the Chinese to cut imports from Australia because they want to support their own dairy industry. There's plenty of things that could happen that could change it. But for me, I didn't do anything. I just let it ride up. It was higher, it fell. I just have left it. I think there's still demand. Whether it will justify a 65 times earnings multiple, that remains to be seen. Yeah.
Yes. Yeah. Nice one, Ren. So, look, yeah, you were wrong, but we're all wrong when it comes to investing most of the time. However, whilst being wrong, you are on a winning stock by picking it, well before the $2 mark. So, I guess that gets a bigger tick. And as you said, it will remain to be seen what happens to this stock. But as you said, it's all about the growth expectations. And with these companies, looking at the PE specifically in relation to the stock is sometimes, look at Amazon, it had PEs of in the hundreds, obviously because the growth expectations on it were massive. You can't really take them in isolation. You need to look at it in a much broader context. So next question comes in from John.
Hold on, mate. You're asking all the questions. I'll ask you this one.
Okay.
So third question, this comes in from John, and he wants to know if there's an equivalent to stake for Australian shares where he can place unlimited trades with no brokerage fees.
Great question, John. That would be the dream, but unfortunately, as far as we're aware, there is nothing like stake for Australians in the Australian market. Most brokerage platforms offer cheaper brokerage the more you trade in either quantity or dollar amount, on a monthly basis. But as far as we're aware, there are no brokers out there who will let you do unlimited trades for free.
Yeah.
That would be amazing. Business opportunity is what I'm saying.
Equity Mates brokerage platform coming 2020.
Coming soon.
I think the big one in the US is Robinhood. They have been saying they're going to come to Australia for a while, but they're yet to come. So at this point,
they're doing the world's biggest drum roll, that's for sure.
Yeah. Well, I think there's probably bigger markets for them to try and conquer.
Yeah,
and I think they're probably still trying to figure out what business model actually works for them. But yeah, look, in the meantime, it really is stake, or you can get cheap brokerage, but yeah, there's not a lot of free brokerage out there.
Okay. Thanks, John.
All right. I'll ask you the next one because that was a pretty short one. All right. So next question is around investing and saving as a young person. So they want to know how we think young people should invest in the context of the large purchases that they're looking to make. So, do they save for a car or a house, or do they invest in the market? Or should you invest in the market to grow your savings for the house? So, yeah, do you have any thoughts on sort of the interplay between saving and investing?
Sure. So again, this is probably a question that needs to be asked to your financial advisor. I think is the first thing we should say. We're not here to give specifics on this sort of stuff because it all relates to your personal situation. But I guess I can answer this from my sort of experience and perspective and how I tackle this. It is a good question. You know, how do you go about saving for a house when you want to start also building a share portfolio? Depending on your income, it can be very difficult to do both. And that obviously boils down to what your financial goals are. And you need to start looking at things like your time horizon and your risk appetite. So say, for example, let's use the example of a house. You're trying to save for a house. The way that I would tackle it is I am a strong believer that in this day and age, you can build a share portfolio with as little as $5. So you don't, if I was to be saving for a house, I would be separating the two because as our listener mentions in their questions, you know, the value of compound interest is huge and it only gets better the earlier you start. So if it just means putting small amounts away into your share portfolio and putting the majority of your money towards a house, then by all means, you can still run parallel. I think that if you're saving for a house and putting all of that savings into stocks and hoping that, you know, the rise in your share portfolio will increase the speed at which you can save for that house, that's obviously a lot more risky than if you were to keep that in cash in the bank. I'm not saying that that's a good or a bad thing to do. I do know of people that use stocks to help reach their financial goals and then they take it out. But my personal approach to investing is that I keep the two separate and I try as hard as I can not to sell stocks for any reason other than to take profits and buy back in. I wouldn't be using them to buy a house. One of the advantages of having stocks, a portfolio is that you can use that to borrow against. It's an asset, so you can have that there and borrow against it for things like a house or a car. So that's my take on that. Ren, do you have anything? How do you approach it?
No, look, I think I'd be repeating a lot of what you said. From like my general rule is if I'm trying to spend save for something to spend in the next 5 years, I don't want to put it in the market, just because the market could be volatile and you need to invest for the long term. So in practical terms, if you're looking to save for a house, definitely take advantage of the super first home buyers scheme, where you can save up to 30 grand in a tax advantage super account for your first home deposit. So that's definitely something you want to maximize. The question I asked about cars, I think specifically for cars, don't overspend on your car. It literally depreciates from the day that you buy it, from the first time you drive it. So do yourself a favor and drive as cheap a car as you can for as long as you can. And if you can help it, don't borrow to finance your car. Just buy a cheaper car. You know, buying into the housing market at least is an investment that will appreciate in value. If you're overspending on your car that depreciates from literally the time you sit in the driver's seat, it's probably not the right thing to do.
No. Take a leaf out of my book, Ren. I'm 27 and I've never owned a car. I just bum a ride from all my mates. So it's a pretty good way to get around, right?
Yeah. Do you even have your license?
Come on.
I don't think you do.
Yes, I do.
Debatable.
Absolutely got my license, mate. Anyway, that's a good question. Thanks for that one, Shards. Next one, Ren. You want me to ask Dan?
Yeah, sure.
So this is to do with setting up accounts. He currently trades through CommSec, but it's under both his and his partner's name. And he was wondering what our thoughts are on trading in individual names, if there's any tax advantages or things to be careful or mindful of when setting up trading accounts in joint names.
So I think, again, this is one where we need to sort of defer to the actual tax experts. But I think in general terms, you lodge your tax return as an individual, even though you need to record your partner's income. So there may potentially be a benefit. Well, you see, I don't know how it works with couples if you can apportion the income to one partner or the other. But, given that you report as individuals, if one person is making significantly less than the other, you probably want the income to be in their name, I would assume. But look, yeah, neither of us are married. You're a bit closer than I am, but look, this isn't something that I've had to deal with, so I would just say, speak to a tax professional.
Tax guy.
Yeah,
I know a tax guy, so I'll shoot this question off to him and see if he can give us a proper answer, Dan, and I will throw it up on our website under your question. So stay tuned. We'll get that across. The next one's coming from Lauren. She is keen for us to do an episode on bonds, different types, pros and cons, how to buy. And is it worth using them to diversify a portfolio and all that sort of stuff? Excellent question. I think, Ren, what we've decided is that we will do an episode on bonds. Just wanted to recognize the question that's coming from Lauren. So yes, Lauren, we will endeavor to do a much more detailed episode on bonds. So stay tuned for that. The next question and final question for this episode comes in from Daniel. This is a great one, Ren. He wants to know what metrics and measurements should we as beginner investors be using to keep track of, and how each metric affects things like share price and how it all relates to the broader economy. He gives examples of, how often does the Australian GDP change, what that change means, and how often interest rates change, for example, and how that affects us. So great question. We can discuss macro and micro. Ren, where do you want to start with this one?
So I think what you just said there probably is a good place to start. A lot of this will depend on your investing strategy. So if you're a macro investor, you'll probably care more about, GDP numbers, global trade numbers, some of the bigger economic indicators, and you care less about company-specific indicators. Whereas, a value investor will focus on particular company metrics, how much debt they have, what their assets are, their cash flow, and will care less about overall economic indicators. But look, in saying that, it really is dependent on the individual investment as well. So, for example, if we were talking about A2 Milk before, you obviously care about the company-specific indicators, but then it's so exposed to China, you will care about China's GDP numbers, you care about international trade numbers, you care about, a bunch of other things like that. You care about the Aussie dollar and how it converts to the renminbi, the yuan or the renminbi? Or are they two names for the same thing?
Probably.
Anyway, but then, if you choose a different company, like, you choose CBA, Commonwealth Bank, then you care about company level metrics, but potentially different metrics to what you care about for A2 Milk. But then you also care about some macro things, but you're more exposed to the housing market and stuff like that. So you care about those sort of macro level indicators. So there probably isn't a set list, and you probably don't want it to be a set list. It really is dependent on the investment. One that I didn't mention there, but does sort of affect everything in the economy, is interest rates. That's one that I think every investor should care about and should be aware of how it affects their investments. For macro level investors, interest rates sort of change everything. For fixed income investors, for bond investors, that interest rate is the sort of risk-free comparison rate, so it makes bonds more or less attractive. And then for sort of value investors, interest rates can form the risk-free rate of a lot of ways that you value a company. So if you're doing a discount cash flow method, as interest rates go up, the discount rate should go up because the risk-free rate is going up. So look, a lot of that may not make sense, but a lot of things, terminology used in there, Ren, that you probably need to be a bit more experienced with investing to understand. So to couple with our
our episode on bonds, we will do a deep dive in all things interest rates. It's an incredibly important topic to understand. It impacts a lot of things, and there are some absolute basics that you need to know. For example, that the RBA, Reserve Bank of Australia, on the first Tuesday of every month hold a meeting where they decide whether or not they will be changing the cash rate for Australia for that month. So we will do a deep dive on all things interest rates, because as you heard Ren explain there, it impacts bonds and cash flow discount models, or whatever they're called. Apologies, can't remember at this early time in the morning. So stay tuned for that, Ren. I guess just briefly, GDP is gross domestic product, if you were wondering what Ren was talking about there, and it just essentially shows the total output, growth of output or decline of output of the economy for that period of time at an annualized figure. So I hope that answers the question. Do you have anything that you specifically track, Ren, or do you? I know as time goes on, I think the message for this question is that you understand how, one metric impacts the other, and you get an understanding of, I guess, broadly how all the economy starts to work, which is why you said, you shouldn't really have a prescribed list of things to look at, because taking things in isolation sometimes is almost pointless, because you need to understand what the flow and effects of all these metrics are. But is there anything other than interest rates that you, I guess, enjoy tracking, or right at this point in time?
Look, at the moment, things like global trade numbers are interesting because of the broader, political side of it, with this trade war and what that could mean for global growth. But I think the general takeaway should be the reason that there are so many different indicators is because there is no set of perfect indicators.
Yeah.
If there was a list of 8 indicators that you could watch that gave you all the information you needed to pursue an investment strategy, to understand what's happening in the global economy, blah, 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 there would be no other indicators, because you'd get all the information you need. But the fact is, companies are so complex, let alone economies and how complex they are, that no indicator is perfect. And it really is about understanding what's behind those indicators and what those indicators are telling us. That I think that's where the real value is.
Yeah, completely agree. So stay tuned for 2 episodes out of this, and this is why we love getting these questions in. So we've got one episode coming for Lauren on bonds, and then we'll do another one in line with the questions Daniel was just asking on interest rates, both 2 pretty important things to understand. They can seem quite complex for the beginner investor. Don't worry, we will break it down for you so you can totally get an understanding of what it's all about. So, Ren, that brings us to about halfway through questions. We will leave it there for today, and we will revisit this for our next episode, where we'll answer the remaining questions that have come in from our listeners for Ask Us Anything. So, unless you have anything else to add, we will talk next week.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.
Equity Mate.
Hey, Equity Mates. I really appreciate the support and love that we get from all of you guys. Obviously, we are doing this for free. We don't expect any money from anyone, and we do it for the love of investing and equities. But there is one thing that we could really appreciate your support from. Ren?
We don't ask for money, although if you want to send it our way, we wouldn't say no. But the biggest thing you can do to help us grow the podcast, get more people listening, is to just jump on iTunes or whatever podcast platform you use and give us a rating. Ideally 5 stars. If not, if you think we're only worth 3, then that's your decision. But yeah, it helps us massively in the ratings and to get more listeners and to grow the brand.
Nice. Leave a review and also tell your mates.